Okay,
Hey
cool.
guys, welcome to another exciting edition of Elevate Career Discussions. I'm very excited today to be joined by Nikhil. I'll give you a quick intro, but a few kind of tidbits. Nikhil works at a $15 billion hedge fund in New York, number one. He's also, a rare distinction. He's actually, been at he joined the hedge fund industry right out of investment banking, which is extremely challenging to do for all the folks that are looking at it. So I want Nikhil to share some of his perspectives of that as well as we'll spend the discussion today really diving into the hedge fund industry and trying to understand it and understand kind of what's been going on lately, what he does on a day-to-day basis, and really what do you do as an investor in this space to drive alpha. So without further ado, I'll introduce Nikhil. Nikhil's background consists of Queens for his undergrad, worked at Goldman Sachs as an investment banking analyst, and then straight away recruited and joined a hedge fund right after that. So I'll maybe have him do a quick 30-second, 1-minute intro, and then we'll dive in. And before I forget, for all the new listeners and members here, Elevate is the premier career success network for folks interested in business technology and finance careers. And if anyone wants to capture, listen to this or prior podcasts or future ones, you can always listen to us on Apple, iTunes, and on YouTube. So without further ado, Nikhil, I'll turn it over to you. Maybe give a quick intro about yourself.
Yeah, for sure. Thanks, Kaushik, for having me on. Really thrilled to be a part of this and to help all you folks out that are listening. So, yeah, as Kaushik said, so I grew up in Canada. Actually went to school there at Queen's University, and then spent about 2 years or so in the investment banking group at Goldman in the FIG group, and then right after that, basically joined a firm called Untitled Capital, which is a $15 billion long-only fund with about 9 investment professionals. Our strategy is pretty simple. We look to buy good businesses that can compound value over the long run. We hold about 40 to 50 positions. We're industry and geography agnostic. We simply look for the best businesses all around the world and try to buy them when we think that there's a little bit of a dislocation in price. And I'd say that we make our money less from having that discount compress, but more so from having the business's value compound over time and benefiting from holding on to those winners that continue to win.
Got it. That's really helpful. We'll dive into that in a little bit. Maybe we'll start off with what attracted you to the hedge fund space. Obviously, hedge funds over time, starting with around the financial crisis to a lot of maybe this decade have done tremendously well. So there's that. But what personally attracted to you to it, and perhaps the types of investments and types of work that you'd be doing in it?
Yeah, for sure. So I guess the big question that I had kind of coming out of investment banking was whether or not to go down the private equity route or the public markets route. And for me in particular, I chose the public markets route because for 2 reasons, basically. One was, I was initially interested in business and finance because I thought of it as kind of the gateway towards understanding how the world worked. And I thought, investing, you're basically learning about how different businesses work. And, as a result of that, you kind of learn how the world works. So what was really important to me was trying to get as much reps as possible. So having a breadth of experience in terms of learning about as many business models as I possibly could. And I thought that being in public markets, a lot of it is churning through new ideas, and as a result of that, you benefit from learning about a bunch of different businesses. And if you contrast that to private equity, where you're kind of only looking at a handful maybe of potential investments in any given year, but you're getting very, very deep into the weeds on them. I was more interested in kind of the high level picture of how different businesses worked. And seeing a bunch of different types of businesses all around the world, as opposed to, really getting into the deeper nitty gritty, understanding 5, 6 businesses in a given year. So the breadth versus depth, I was more on the breadth side. And that's one of the reasons why I chose public markets. And then the other reason was, I was very interested in understanding why a good investment was a good investment. So that comes from sourcing ideas, right? So looking around the world, trying to figure out like why certain businesses or certain securities are good investments, and as opposed to sort of executing a process and seeing at the end whether or not it's a good investment. So what I'm trying to get at is I think that public markets, what I thought at the time was public markets was a lot about trying to source ideas and less about executing, which is executing is simply buying the security and you can buy anything that you want basically. Whereas in private equity, it was a lot of you can only sort of buy what's up for sale, and as a result of that, you kind of spend a lot of time executing a process on what is up for sale as opposed to going out and trying to find what is an interesting thing to buy. So, so if I were to summarize that, for me, I was interested in investing because I thought it was a gateway towards understanding how the world worked, and I thought public markets in particular was the right place for me to pursue that learning, because one, you have more breadth, so you can learn about many different businesses, so you get a lot more reps, and then two, a lot of the job is really sourcing and figuring out what makes a good investment. So as opposed to just executing what is potentially up for sale. So if you're sourcing a lot more, you can kind of you be a little bit more creative and look around different areas of the world to figure out what is a good investment. And so those are sort of the reasons why I chose public markets.
I love that answer. I think that's super thoughtful and actually really lays out some of the fundamental differences between a lot of the exit options that folks who are listening might have, with the public markets versus the private markets, and really understanding that on the private equity side, it is, going through the motions of doing a deal and looking at it as a deal, as opposed to on the public market side, it's more on the, fundamental investment, idea, stock, or whatever it is, I think it's more on the idea side, whereas here's more on the process side. So I think, Nick hit spot on. And I think the other thing he touched on is just developing that interest in investing and really understanding that that's an area that I really wanted to do. And Nick, maybe you spend a little bit of time on the sourcing side. Like, what do you do, to become better at finding good investment ideas? Like, do you have certain methods that you use to screen everything, or do you take macro theses and then kind of drill down into like good businesses that do that well? Maybe shed some light on how you approach getting new ideas.
Yeah, it's a good question, and it's probably one of the toughest things of the job is trying to figure out where to spend your time on and where to spend more time on, and figuring out what could be a good area to invest in, or what can't be. And I guess I would preface this by saying that, look, I think unlike maybe investment banking, consulting, and private equity, where the strategies are very similar, or like what you're doing is very similar across different banks or different consulting firms, or even within private equity. Kaushik can maybe speak more to that than I can. Public markets, there are a vast range of different strategies, because people have macro views, people have concentration versus diversified, people have funds that maybe only look at securities in Brazil, some people will trade things intraday, some people will hold things for 10 years. So as a result, and some people will take on leverage, some people will not take on leverage. So as a result of that, I don't think there are just so many different categories of types of investing in public markets. So if you're approaching a job, I think that's one of the most important things, is really figuring out what type of strategy that makes sense for you. And you may not get it right the first time, and you can move around and all of that. But I just wanted people to know that there's unlike maybe some other career paths where most of the jobs are very similar and there's cultural differences, like the jobs are very different depending on the strategy, and there are a vast range of strategies in public markets. So in terms of sourcing, like our strategy, we try to look for great businesses all around the world that can compound value over the long run. And I think the way I go about sourcing is kind of a combination of many different things. So, first, I guess, is, you can't expect to be amazing at sourcing on day one, because you don't really know what a good business is unless you've seen kind of all the businesses in the world, right? So it's sort of an experience thing, and as you get older and have more reps under your belt, you kind of have a better sense of what could be a good business, and that just takes time, and so you have to be patient with it. What I try to do is I do a combination of different things. So um, I'll run my own screens, and a lot of the screens are kind of tailored to things that we particularly look at, and sort of metrics that we focus on are sustainable operating income growth. I'll screen to try to triangulate those things in different ways, and then also look at maybe different nuanced ways of screening for similar types of things, whether it be like insider ownership or management change or spin-offs, where the situation might be a little bit more misunderstood. The other way that I look for ideas is I look at companies that we already own or companies that I already cover, and I look for comparable companies, maybe in different areas of the world, or even within the same industry, that that where they may not be competing so heavily with each other and they sort of coexist. So those could be good areas to look for. And then also looking at the supply chain. So like maybe this is a good business and or an okay business, but the better business is the supplier or the customer, or so just looking at periphery areas of the supply chain of businesses that I find are interesting and finding opportunities that way. And then also I think having a good network is quite important. And so in some ways, you want to have a network of people to help, throw ideas to them and then have them give you ideas. But you have to be careful with that, because you don't want to be biased. You want to make your own decisions. You don't want to be misled in some way. So you're having a tight knit of friends where, it's very cordial, and it's not, people don't get as defensive, and you don't get swayed too much. I think that's another way of building a repertoire of ideas. And yeah, I think those are sort of the main ways that I do it. But it's the toughest part of the job, and I think, I guess, one last thing that I would say is that there are also there are sort of patterns that kind of exist. There's a psychology aspect of public markets, and there are certain securities that fall in favor and out of favor at different times. So over time, you kind of recognize some of these patterns, and as a result of that, you look for different businesses in different areas that result from some of the patterns that work for your specific strategy. So pattern recognition is something that I also look for in terms of sourcing ideas.
Yeah, that's a great answer. Maybe comment a little bit on, you made the jump right after investment banking to hedge funds. What are some of the pros and cons even of making that switch right after investment banking versus going and doing something the private side and going to hedge funds?
Yeah, I'm still, I've been doing this maybe 5-6 years. So I'd say that I'm maybe still a little bit early to see some of the benefits of potentially going down the private equity or the MBA route. At the time I was more like, if this is what I want to do, like, why waste my time doing other things? But as you get older, you sort of realizing having different experiences is sometimes helpful, right? And you build different networks and you see things a little differently. And so I don't have a strong view either way. I don't think I can, just given I've only been, I think maybe after 10 years or 15 years or 20 years, I can come sit back and be like, this would have been a better route. This would have not been a better route, but it's hard to say at this point, I'd say. So, I think it's,
yeah, go ahead.
What's up?
No, I said, if you know what you want to do, just kind of do it. Don't kind of, if you can, right, just kind of go for it.
Yeah, there's a little bit of that. I would say that, exactly. But the flip side to that is like, well, if you can get different experiences, like, would that be complementary over the long run to your longer term career in public markets, right? So it's like, in 20 years, maybe I'd look back and say, like, it would have been good to have done private equity and then an MBA, because I would have had those experiences and they would have helped me see things a little differently. And but for me, it's too early to say that, because my peers who've just come out of MBA programs or jumping in from private equity, they just sort of started, right? So like they, over a longer period of time, if that experience would have been better, you kind of will see that over time. And I would say that so I guess, yeah, to your point, like, yeah, I just felt like, look, this is what I want to do. I'm going to do it right now. I found a great job that I really want to pursue, and there's no point wasting time. But the flip side is, well, maybe there are benefits of seeing other things, and it's hard to right now. Obviously, that there, you can't weigh that because like they haven't had longer careers yet. So, but maybe there are benefits, and I can see that. And I would say that the early observations that I have from some of my friends who've jumped in from private equity is that private equity, in public markets, it's very much a psychological game. And different styles of different ways of thinking about the psychology of investing. And with private markets, there's less of the psychology of investing, I would say, just because things are just not like, you're not marking things to market every single day, right? So and you're not seeing the emotional ups and downs from that. So in the market, and then also your own emotional ups and downs. So I think there's an element of like, this is what the market might think kind of thing, which creates a psychology type situation. And what I'm trying to get at basically is that I think with private equity, sometimes being so super detail oriented, which is what private equity trains you to do, everything has to tie, like you're buying a whole company, so you have to go through a massive diligence process, which is extremely valuable, to go through that and to understand like how every single part of the business works. But I think like sometimes stock prices move based on very high level things. So what I've noticed is some of my private equity friends who jumped in, like they get very caught up in some of the details and miss maybe sort of the big picture stuff that are really going to move the stock. And I think that'll just take time for them to realize that some of the nuanced stuff like doesn't matter as much. But at the same time, like maybe it's not to say that having that experience of going very deep is wasted. It's just like, you have to know when to go deep and know when to not go deep. And I think that sometimes is a little bit of a challenge for private equity guys coming into the public market world. So.
That's fair. No, that's fair. I think there's always trade-offs, and your experience is really, really important. There's no substitute for it, but there's always trade-offs for the other. So fair point. Maybe talk a little bit about the skill set and like of what it takes to be successful as a hedge fund investor. Do you feel like, first of all, like it's a couple different things here, like the types of analyses, are these still like fundamental DCF based analyses? Where second thing is like technical skills, like are you expected to do like coding, quant skills, things like that? And then maybe on the last side, like soft skills, like what are the things in terms of communication or convincing people of your ideas, how to present things, maybe break those down in those three things in terms of skills.
Yeah, okay. So yeah, like look, the fundamental analysis is there, and like again, I'll preface this by saying that as I said earlier, every fund has their own way of doing things, and some may tailor more to one of these skills versus others. But I can speak to my experience, and from what we do and what we try to do. The fundamental work, yeah, like it's a lot of understanding what the company does, what value it provides, how big the market could be, what the growth path could look like, what competitive advantages the business might have. What the supply chain looks like. Are there sort of any weaknesses, and how the business is investing its cash flows, or is it doing so in a way that's enhancing the quality or return of the business, and evaluating management and seeing what their actions have been, and has that generated value or detracted from value. And so I'd say like that, all of those types of questions I would put in the bucket of fundamental analysis. And you can go deeper on any of those things, like depending on what the situation is or what's more important. That's very relevant in this job, especially my role, where we're sifting through many different businesses and trying to figure out which ones we like or don't like. You kind of focus on that fundamental analysis as an initial screening tool. In terms of like the valuation and the rigor around that, I would say that it is important. I wouldn't say that it's like we are more quality of business first, valuation second type investors, and so I think the first part of that analysis is a lot more important than the second part of the analysis. And basically the reason being, the longer your time horizon, the less valuation matters because the more quality of business matters over the long run. So but there are other funds that have shorter time horizons where valuation and dislocations and all that kind of stuff is way more important than the fundamental stuff. So it really depends on the strategy, but for us, it's less important. And in terms of the metrics that we use, like I think the most important, my personal view, and this is how we employ it, is valuation is really a function of opportunity cost, in my opinion. So it's opportunity cost relative to what else you can buy at the moment and what else you could potentially buy in future or previous periods of time. So if you think about how that manifests itself, is like you'll look at valuation on a consistent way relative to your portfolio, because those are things that you already own, and then see if there are situations that present themselves where the valuation is attractive relative to the growth profile or quality of the business, and relative to your own portfolio. So it actually is accretive for you to buy that potential security, or basically you look at it and you're like, okay, like this is a good valuation, but like there are different periods of time where like this is traded and more attractively, and maybe there are better entry points. So like opportunity cost being what else you can buy or what else you already own, and then also at what point in time does it make sense to sort of buy that or not buy that. So that's how I think about it, and that's sort of how we think about it in some ways. And then the third thing was the soft skills, right? So the
Before that, Nick, like the coding and like the quant side, like are you expecting
right,
like
yeah,
what technical skills?
right, yeah. Sorry, I missed that part. The the coding and the quant side, like it's not like a big part of what we do. I'm sure everyone has their own way of doing fundamental analysis or coming at the valuation, and I think I guess, as I was saying earlier, the longer your time horizon, the more the fundamentals, like qualitative aspects of the business, matter a lot more than maybe spotting an asymmetry in some with your quant analysis that like allows you to arb a US dollar security versus whatever. Like, so like that kind of stuff matters in the short run for sure, because there's a lot of funds these days use factor analysis, and like that's kind of quantity where there are certain securities that are exposed to a value factor that are trading off today. So like your quant model will tell you that you should degross and buy more value stocks on those sort of days. Like then that's where that kind of comes into play. That a lot of hedge funds do that. A lot of like sort of market neutral hedge funds do that. So like the Citadels of the world and the Millenniums of the world and a bunch of the Tiger Cubs are leaning in that direction. We don't do that as much. We more just focus on buying good businesses for the long run, and we look for when the quants are kind of selling off securities for factor reasons and not long-term reasons, is buying opportunities for us over the long run. So quant skills is not really something that is big in my day to day. And in terms of coding, coding could be a time saver. Like even back when I was at Goldman, like people would write like formulas or whatever, a program within Excel that would like help you speed up the process of you gathering information. And like those are just little like ways that you could just make your process more efficient. And like in some ways, coding and quant type stuff apply to screens, right? So it's like when I'm going out to screen for potential new ideas, like one thing that I was thinking about potentially, I'm no quant guy, but like this is something that I've been thinking about in the back of my mind. If I could figure out a way to do this, it would be super helpful. But basically to look at our portfolio and see like, well, what criteria within a screen would spit out the max number of stocks within our portfolio, and then like go screen other potential stocks that could we'll just see what factors those uncover, and then like try to find other stocks that like would fit our portfolio. So like, that's like a quant type way of looking for a new idea. But you don't need to do it that way. You can like look for new ideas in other ways as well. So I think the quant and coding stuff, it's not a requirement. It could enhance the productivity if you like to, but you don't, it's not a core part of the strategy. and then yeah, in terms of the soft skills, like yeah, that's in some ways the interesting part of the job, and like the fun part, and the challenging part as well. Like, to get to put a big position into a portfolio, you need to convince a lot of people, right? So first you have to convince yourself like that it's a good idea, and then you have to convince other people, and like that's a lot of like communication, and you know being able to present your points, being able to react when people ask you questions, like um, being honest when you're wrong, like presenting all the facts and including all the risks, and you learn that over time as well. Like, look, like I think one of my early lessons was realizing that, like, the world is just incredibly complex, and like there are any investment you make, there's bound to be something that goes wrong at some point in time. So you have to be humble about that, and you have to recognize that. And there's a little bit of a balance and an art towards, like, pushing for something you want to get into the portfolio, but also priming people for situations that could arise that could cause the stock to go in the wrong direction. So, but that's I really enjoy having those conversations, and ultimately that's what the job's about, is debating potential investment ideas, and getting. And I don't think you should think of it as a I win you lose type situation. It's more of a discussion, and it's more like you know these are smart people. Like, what do they think? Like, what are their issues? Like, are they valid issues? Are they not valid issues? And then be kind of objective about it, and work towards a process that like helps you get something into the portfolio, but also make sure that once it's in the portfolio, you've kind of vetted out all the potential risks, and people are on board with it, and all of that. So yeah, I think there's a lot of soft skills that are part of the job.
Got it. Well, that's super helpful. I think that was very comprehensive. A few more questions. One is around, again, generally, at what point are you looking, as working in the hedge fund industry, like to start like getting potentially equity, like, in the fund, et cetera. Maybe talk a little bit about, again, not specific to kind of, your fund, but just generally what you've seen, and what folks should expect, like at least on the, the private equity side, a lot of folks, get carry in the fund, like once you hit, a senior associate, or a certain number of years tenure, or director, or whatever. So what types of comp structures are out there? Where's that, what does that look like?
Yeah, so um, I would say that my observation has been like, look, it really depends on the fund. Like, there's no hierarchy really in terms of the public market world. So, it's not like there's not like a associate and then VP and then all that kind of stuff. But I can speak broadly just in terms of what I think the differences are in terms of the comp structure. So, um, in the public market, in the hedge fund world, there are performance fees, and the fee structures are similar, I guess, to private equity in some ways, and but the way that they're paid out is a little bit different. So I think with private equity and VC, even, like, they're paid out at the end of sort of the life of the fund, whereas like in public markets, it's paid out at the end of the year. So you get whatever the 2 and 20 to 20% maybe performance fees, and because everything's mark to market every single year, you can get that money like a lot quicker, I guess, is sort of the point. Uh, Conversely, like, if things don't work out, like, like funds could shut down faster. And so it's just a quicker feedback loop, in both ways. Like, if a private equity fund has like one bad year in their like 6-year life, like maybe that like ruins the whole vintage of the fund. And like, you won't find that out until like much later. Whereas like in public markets, you could get paid for a couple years early on, and then that happens, and then like, well, then at least you got paid for the first couple of years, and as opposed to like having to wait that for that carry for a long period of time. So I just think it's a quicker feedback loop. I think, look, if you the job is really just about generating ideas that can generate money. So it's like, if you can work your way towards proving to people that you can do that, and you can do that successfully, like, people will give you as much responsibility as possible, and like, you're allowed to put on as much position and risk as possible. And it doesn't happen right away, like, but over time you can get like P&L responsibility, and it depends, like, it really depends on the firm and all that. But so I think eventually people get paid on formula. So it's like, these were your ideas. This is how much profit it generated for us this year, and as a result of that, this is how much performance fees that we got, and you'll get like X cut of that, and that's similar to carry, and like with the exception that it gets paid out annually.
Got it. Super helpful. And then a couple things. You obviously have been at one fund for 6 years. Incredible for the longevity of the fund, yourself, etc. Obviously, 2018 and 2019 haven't been so great for a lot of other funds, just given how the market's done and maybe how the hedge funds have done. So what is kind of maybe your outlook for the industry, right? Maybe talk a little bit on a macro level. What happened in 2018, 2019 that a lot of these funds shut down, and then what do you think the outlook is for the next couple of years for the hedge fund industry?
It's a tough question. Look, I think this job in general, investing, is a very tough job, and I think to be successful at this job over a long period of time, you have to have a process, I guess, but you also need to be able to evolve and adapt as the times have changed, right? So I think you see a lot of these funds that are shutting down. I think a lot of it has been because they just haven't been able to evolve and adapt. Like, what were good businesses like 8 years ago are not good businesses anymore. And like, it's hard, like, it's hard to change, your mind, because, these good businesses, like, which were traditionally good businesses, they'll get cheaper and cheaper. And you're like, well, like, what is this? Should we be doubling down more? Should we not be? Like, in this world of low interest rates where disruption is everywhere, like, great businesses are being disrupted left, right, and center, and you have to be nimble and able to evolve and adapt. I think that's one reason. I think the other reason is probably the changing of how the product is distributed, and with the rise of kind of passive vehicles and ETFs and all that stuff, and that starts in the most liquid asset, right? And then it works its way towards probably more illiquid assets over time. So, I think public markets is the most like liquid asset class, right, for active management. So, as a result of that, like having a zero fee competitor that anyone can buy at any point in time, puts just a lot more pressure on the industry. So, and I think there was probably a lot of overcapacity, and I think that will kind of, I don't think active is dead. I mean, obviously you're going to need some sort of price discovery. So, but whether that, that it settles at 50-50 or, 80-20, 80 passives, or, 60-40, 60 active, like, I won't pretend to know where that lands. But I would say that, I do think that, like, say, that this trend is going to happen in all asset classes essentially, and so I think the public markets is sort of the first one where it's happening, but I think it'll happen all across the board, and then it'll just you just have to be smarter about it and thoughtful, and to survive that kind of storm. But people will need to. There's a balancing effect, like so. But
no, I think I think the combination of some of the stuff you mentioned, to me, it was how the market had just kind of continually kind of been driving one way, and the rise of passive, obviously that has been going on, as well as I do think on the overcapacity side, there just seemed to be some of that. But like in all markets, like things always like are never as good or as bad as they seem, and it always tends to level out to end up with types of businesses. So I agree with you.
Yeah.
Last point, Nick, I want you to hit on. Maybe talk a little bit about your interview process, specific to the fund or not. Just how, when you were in investment banking and kind of making the transition, what did that go through? I mean, did you have to come up with ideas? Did you have case studies? Like, what types of stuff were you put through in order to kind of break into this, incredibly tough industry?
Yeah, look, it's all of the above. I think the first thing is you have to be prepared. The second thing is you have to be passionate about it. I think different places will have different ways of interviewing, but I think like the common things that people will ask you are, why are you interested in investing? Why are you choosing public markets as opposed to private markets, who your favorite investor is, what's your favorite investing book, what is your investing style, and they'll also ask you for a couple of stock pitches. And I don't think anyone expects you to have like an amazing pitch right off the bat. Is you don't have experience to do it, but you need to be thoughtful in how you present it and like what you think some of the key areas are and like what the risks are, and have a target price and all those basic things. And I would say that, like, what I tell a lot of people actually when they ask me about this is you want to kind of go in being a little bit differentiated. Like if you go in and you're saying like, oh, my favorite investor is Warren Buffett and I read Margin of Safety, like, you got to know that, like, these guys are trying to look for like alpha, right? So it's like they're like 80% of people are going to say that. So you should kind of go in with like, oh, look, like my favorite investor is like Stan Druckenmiller, or like I'm really impressed with his like 30 years no down year track record, and I found his calls on like this 2020 year to be very interesting, and he's long like whatever like commodity currencies. That's like a way better answer than saying like, oh yeah, I like Warren Buffett. Like, so just be thoughtful of like the questions that they're gonna definitely ask you, like, who your favorite investor is, what's your favorite investor book, what makes a good company, and just having answers that like are just like, that answer the question, but have a little bit of it that differentiate you a little bit, will show them that one, that you're very passionate about it, and two, that you may just think differently, and like people who in this industry, people want to find people who just think differently, because that's part of the game of trying to find alpha, is thinking differently. So that would be my key piece of advice. But yeah, in terms of just the process, like, yeah, stock pitches and all those questions that I had mentioned earlier are things you'll get asked.
Okay, cool. So can we do a quick lightning round, Nick? I want to ask you a few questions.
Yeah, sure.
End of 2020, are the market up 10%, flat, or down 10%? I mean, this is not this for the audience. This is not investment advice. But
I am no macroeconomist, so I have no idea, and that's why I'm going to go with flat.
Okay, fair enough. You're very, all right, fine. So, and what is your favorite investing? I was actually going to ask you this, but you brought it up. What is your favorite investing book, like over time, and then kind of what are maybe something you're reading now?
My favorite investing book is actually a psychology book. It's called Super Forecasters. I would recommend everyone to read that. It really just kind of goes, it talks about an experiment that this professor did in terms of getting a bunch of different people to go through an exercise and making judgments on a variety of different issues, whether it be economical or social or what have you. And then he kind of wrote a book about like the characteristics of the people who he deemed were super forecasters, so who were able to make the best predictions on a variety of different events. And I think it's really, it's very interesting, like sort of the 9 or 10 things that he points out, and it has less to do about being like a crazy super smart math genius or quant, and more to do about like some of these softer like wisdom type skills that just allow you to sift through the noise and make good judgments. So, and that's what this job's all about. All the fundamental analysis and all that. It's like, once you know it, it's not that hard. It's more about providing good judgment. And this book, I think, was really good in terms of just, outlining what some of those characteristics are. The book I'm reading now, like I'm actually reading this book called Educated. I actually really like and I enjoy reading biographies and psychology books. And so this is just a biography about a woman who grew up in a small town in like Idaho, and sort of her life, and like she was homeschooled and then went to school, and like and she sort of talks about her life. So.
Okay, cool.
Nothing to do with investing, but I enjoy reading books.
At least I'll pick up Educated. What are maybe 2 or 3 publications, and you can leave the journal in and out, whatever, but maybe what are 2 or 3 publications you read, daily, weekly, something regular?
Yeah, so like I always read the journal in the morning. I think the 2 things that maybe are a little differentiated that people don't necessarily pick up or read as much that I always read every morning is in the journal there's this publication called The Daily Shot, and it's basically like 50 charts and like one-liners on each of the charts of things that are just affecting like the world right now, or the markets. And like, so maybe it'll be like, oh, like look, like the New Zealand currency is down like 10% today, and like this is sort of what's happening. And like it'll just be a chart on like, or did you know like X percentage of people consume soybeans, like, so it's just like very interesting facts, and like and all graph form, so you can kind of punch through that very quickly in the morning. And I always find like 2 or 3 interesting graphs from that like every day. And then I like reading The Economist Espresso in the morning, so it's just like small paragraphs on sort of what's happening in the world. And I find it's a little bit more a global perspective than the Wall Street Journal, which is a little more U.S. centric. So that's what I read.
Awesome. Okay, 2 more. One is, what was like what was a class maybe you took in undergrad that you still like use things from? Like in statistics, like whatever class that you feel like you use, so, the knowledge or things you learned from.
This was a long time ago when I was in college. the the thing that I use the most, obviously, is probably accounting, like which is a boring answer, I think, but it's the most practical, I would say.
Okay.
So yeah, I mean, also macro econ, like it's good, it's helpful to just
Okay.
because a lot of
So
stock prices are
like,
particularly with that.
art history, because whatever. So that's fair enough. It's fine. And then lastly, like one piece of advice you give the audience, maybe something that you've relied on over your career, but as people embark or continue through their careers, on something that you would like to share, to the audience, with the audience.
I mean, I'd say that like the biggest piece of advice that I'd give people is to to just to be yourself and to be honest. Like I think a lot of people, if you get caught up in I'm sure all these people are very successful, or going to places like Goldman and McKinsey and all that. And I think if you can get very caught up in not being yourself and not being honest to who you really are. And I think just given like all the personalities at those types of places. So just I think what goes a long way is people who are who are willing to work hard, but are also willing to admit when they're wrong, and like be their own self and not try to be someone else. And I think that'll make you happier as a person. And I think people will pick up on those things a lot more, because it's rare to find people who are just honest and who are themselves, I think, especially in this big talent pool. So
Yeah, no, awesome. I love it. I think, first of all, thanks so much. I think it was a it was a thorough, but also really insightful discussion overall. I think we covered so many different topics. So really thank Nick for your time. And really to your last advice, but your honest views on a lot of the things that I threw out there, and the questions wise. So I think our on behalf of all the folks that are listening, I want to thank you, and I think it's tremendously valuable as a resource. So thank you again, and best of luck new year.
Thank you, Kaushik. Happy to be here, and best of luck